Hey, Max.
Awesome. Awesome. Well, thanks, John, and thanks, Hedge, for letting us present here. My name is Max Timmins. I'm the VP of Brokerage Services at EdgeQX. Joining me today is, we just heard about Futures Trader 71, Morad Askar, and then Matt Ratliff of InvestiQuant. And today we'll be discussing long and short quant trading in futures. I'm sure you've heard this next slide quite a bit today, but got to say it one more time. Derivatives trading is not suitable for all investors. Opinions expressed by the panelists do not necessarily represent those of EdgeQX, its officers, or other personnel. Past performance is not necessarily indicative of future results. So today, what is our agenda? Today, we're going to start off giving you a little brief understanding of who EdgeQX is. I'm going to pass it on to Matt, and Matt's going to discuss a little bit about InvestiQuant, which then he's going to continue and provide some of his knowledge towards the crisis correlation, the hidden risk, which then we'll dive into what you're all here and interested about, and that's EdgeQX. What is it and how does it work? And then why is it necessary to consider a quant trading system, and then how to get started. And then at the end, we'll give you all a special deal on the program. So to start, who is EdgeQX? EdgeQX is an independent introducing futures broker. We launched in April of 2020. However, the team here has about 20, 25, 30 plus years of experience in the brokerage industry. We have a team of award-winning personal brokers. So at EdgeQX, when you join EdgeQX, you get access to a personal broker that you can email, call for any questions you run into. We're focused on serving active traders and investors. We have a 5-star average Google review, and we released our EdgeQX program in September of 2022. So Matt, who is InvestiQuant?
Hey, I'm Matt from InvestiQuant. I am a product manager at InvestiQuant. We've been around since 2008, and we specialize in statistical trading. We do quantitative auto trading programs. We also create tools that have been used by professional day traders and prop firms and the like out there. So we kind of specialize in statistical based trading. We use some machine learning algorithms as well.
Awesome. Well, maybe you could shed some light into this crisis correlation, the hidden risk, what it's about, and provide some of your experience towards it.
Yeah, so I imagine most here has probably experienced the hidden risk called crisis correlation without necessarily knowing the term that I'm using for it. And what this chart is showing is the performance of different assets in the year 2022. So just last year, and you can see we've got gold there on the far left. Next one is the Barclays Hedge Fund Index, which is an index of the top 600 hedge funds. The S&P 500, NASDAQ, got a 20-year treasury bond, and Bitcoin. And had you split your money into those different assets going into last year, you probably thought you were pretty well diversified leading up to 2022. You would have seen these instruments kind of ebb and flow, some being up, some being down. And if you would have split your money across them, you probably would have had a good year going into 2022. But what we saw happened in 2022 was crisis correlation played out. And crisis correlation, it's a term that comes from a paper titled A Study in Traditional Asset Correlation in the New Millennium. And it's written by Chisholm and Chase, which you can Google that and you can download it for free. It is publicly available. And the crisis correlation is referring to a phenomenon where during periods of market crises, liquidity declines significantly and investments become 2.5 times more correlated. So if you want to think about it in simple terms, when markets go into crisis mode, people just sell everything. You've probably done this yourself. I know I have. But that's exactly what we saw take place over the past year in the markets. And the average of those 7 assets right there was down 26% last year across all of those assets. So normally you would expect things like gold or bonds and hopefully Bitcoin, we didn't really know at the time, but you would hope that those different assets would rise in uncertain times when markets are selling, and that would kind of help offset the losses from your other assets like the S&P 500. But that's not at all what happened. You know, if you were invested in those different assets for diversification, then your diversification failed you. And the way the market's, currently behaving, it kind of looks like we're going to have more of this ahead of us this year. So the question becomes, in regards to crisis correlation, is what's the solution? How do you protect yourself from this phenomenon that's taking place here? And Max, you can go to the next slide. Yeah. So what we found, the best solution is for crisis correlation is to diversify some of your capital, not necessarily all of it by any means, but some of your capital into short-term trading strategies that can trade both long and short. And by doing this, you can profit from when the markets are going up as well as when they're going down. And when markets get really volatile, kind of like we're seeing right now, it also allows for opportunities where you don't have to necessarily risk a whole lot more on your trades, but the reward potential can become significantly larger than what's normal. So by risking just a little bit more in these volatile markets, you have potential to make a whole lot more because the markets can just continue to run in giant ranges throughout the day. So we started using this type of approach with strategies back in 2008, and it's proven over the years to be a great solution for this crisis correlation phenomenon. So let me give this back to Max, and he can tell you about EdgeQX.
So in response to the crisis correlation, we did launch a program called EdgeQX to help with this. And to give you a brief understanding on what EdgeQX is before we get into the rest of the presentation, EdgeQX is a professionally designed quant fund group of strategies that are combined and traded in a fully automated program aimed to complement your own trading or other investments. We have two programs. One is for the ES and the other is for the MES, so a micro contract. And as I said, it's traded on an intraday basis. We provide daily statements to you for full transparency. It features diversified signals and machine learning with a suggested investment of $10,000 or $100 for the ES. Now, why is it necessary to consider a quant trading program? Morad?
So the market tends to, run for a bit. We've had a historic run here since 2009, just an incredible amount of returns for just the general stock indices that was generally unabated. I mean, we pushed through Brexit, we pushed through all of these things, and so in general, people will prefer not to have volatility, especially in your 401k or IRA or retirement fund. And generally, those funds are long only. There are some really clear restrictions on shorting in a retirement account, if at all possible. So with the crisis correlation that Matt talked about, and the fact that the markets, although the exception is this last bull market supported by, brought to you by the Fed's 0% interest rate and the various bubbles it creates. Now we're at a point in the cycle where we're increasing interest rates pretty dramatically, and the Fed has to cool inflation, and that means long only investments tend to take a hit. And so the idea behind EdgeQX and the idea behind talking to you about getting into something that is fully automated is to take the emotional part of the fact that, you might be seeing some hits come across to your investment accounts, whether ones that you manage yourself as a swing or long-term trader, or ones that you hold in your pension, retirement, and so on. So with a quant-based program, it is agnostic to what the news is. It's agnostic to what's going on. It's simply looking at quantitative measures and historical probabilities and taking the emotion out of this. Like Matt said, and both Max and Matt mentioned, there's a tendency to kind of sell everything at the wrong time. So Our intent here, and the reason you should consider this, is because we're doing this in futures. Again, futures are not suitable for all investors, but the advantage with futures, which can be a large disadvantage in terms of risk, the advantage of futures is that I don't need to, in order to own the S&P 500, I don't need to put up $200,000 buying each one of these 500 stocks or buying the index. I can simply put up a portion of that, especially if we're trading intraday, and use leverage on a short-term basis. Again, leverage brings risk, a higher amount of risk and a substantial risk of loss, but used in an unemotional kind of objective perspective like we have with EdgeQX on an intraday basis, we are taking advantage of movement and volatility that's coming into the market. Remember, volatility tends to dry up in single direction markets and bull markets. Volatility picks up and the range picks up, liquidity dries up in a two-sided or a market that's turning or a market that's selling off. And so being in a product where you don't have to put up a huge amount of money because your money may be tied up in that retirement account or in your investments long-term, 10, 15, 20-year investments, a very small portion can be allocated to a program that takes intraday risk, which means that it's not subjected to news events that occur overnight, wars and crises that happen all around the planet while we're sleeping. And it's just holding for a short period of time within the day with very clearly defined risk parameters, very clearly defined targets. And it just day in, day out, it waits for a signal. It trades the way I've been talking about trading for the last 10 or 15 years to the public, and the way I've been doing it for the last 22 years, which is to just sit, wait for things to set up, wait for the market to come to you, put the position on, define risk, define targets, and let the statistics play out. And this is done for you on a low barrier to entry basis. So that's why it should be considered, looking at putting on your own options trades, equity trades, looking for an option trading system or an equity trading system or Forex. It's all well and good, but it requires you to be on, to be aware. Not only that, it requires you to be very clear in your mind and emotionally where the market is and how you're responding to the events that are occurring. Whereas with a program like this, it doesn't care if you didn't sleep last night. It doesn't care if you feel like trading or not. It is simply taking trades based on quantitative signals, and it's managing those trades with a risk stop, with a predefined, before it enters, it knows what the risk is going to be and puts on the trade. And on top of that, what we've done is we've put this together so that it's not one of these programs where you have to, the minimum investment's $500,000 or something. We've made it accessible with the micro program. And if you want more bang for your buck, the ES, the full-size ES program is also available. The key is long and short here. The other key is using futures, which are capital efficient, meaning you don't need that much money to be able to hold a large position, especially intraday. And then they provide a massive potential, in my opinion, to hedge risk in your own portfolio using a small portion of capital. So these are the compelling reasons behind going with an auto trading program, as opposed to investing in a CTA that may be doing the same thing, where a person is actually in charge of coming up with the trades and putting them on and stuff. This is very transparent, and you're in control. You put it on and you kind of look, let it do its thing for a year, and then reassess in the next year if it's something you'd want to keep going with. Now, just as an example of what that all means in terms of performance, this performance that's shown here is from when the program went live. It's got quite a few customers already on it. It has capacity for more. And you could see, we happened to start out in September. September was a pretty tough month, so the program took a bit of a hit. But you could see the green here represents the EdgeQX return on the ES program, whereas the black line is basically the cumulative P&L since we started at the beginning of September. You can see as the S&P is falling in that period between the end of September and the beginning of October, as the S&P is falling, the program is seeing some pretty decent returns. And then as the S&P rises in the middle of October, the program sees even better returns on the EdgeQX XES program. So there's even though it's trading the S&P futures, which are directly correlated with the S&P, the SPX index, you could see that because it's trading both sides and it's kind of independent of what the S&P does to some extent, it is performing in a way that's not directly correlated with the S&P itself. In other words, it's not an amplifier of what the S&P is doing. It can be rising or can be showing profitable trades while the S&P is losing value, and that's the key element to take away from this image.
Yeah, and some of you at this point might be thinking, hey, I want some more information on EdgeQX. Well, before we continue, I wanted to provide some details on how to find that information. First, all you need to do is go to edgeqx.com. URL is right there, and it'll redirect you to our EdgeClear webpage that goes over all the details with EdgeQX and provides the full cut sheet with all of the data for the ES and the MES program. From there, if you want to get started, you're going to need to open up an account with EdgeClear. And then once everything is submitted, there's some forms that need to be signed and it's funded, then we can get it enabled on your account. If you have any questions, as I said earlier, every trader receives a personal broker at EdgeClear. So someone here will be able to guide you through that, answer any questions that you may have on this webinar or on the statistics or cut sheet itself, and they'll be able to kind of walk you through it and get you up and running. So feel free to do so. Again, it's edgeqx.com.
Okay, one more thing to consider. Here's the catch, and I've been involved with automated trading systems since about 2010. In that I started building, working with others to build systems that mimic the way I trade. And what we notice is that folks look at performance and they tend to, almost like mosquitoes to a blue light, gravitate to the ones that are having an outstanding year or an outstanding month. And so they try to time the entry into the program, and we really discourage that. So some considerations for investing, really best practices, don't try to time it. You're investing in a series of programs that are combined together into what generates a signal from a strategy. So trying to kind of wait for it to have a great month and then put your money in may not be the best way to do this, because now you may be subjecting yourself to a drawdown, right? In fact, Matt, there's some data that you guys have been able to extract on this. Do you recall what that was?
Yeah, it's actually it's very visible if you see it on an equity curve, which I don't have to show here. But typically, investing after down months historically has a better return as opposed to just chasing programs that are making new equity highs each month and starting after an equity high. So there's some statistics that go along with it. But if you start after a down month, or if you just think about an equity curve, if you think about buying as it's going into a dip in an equity curve that's moving from lower left to upper right, which is kind of what you want to see. And that's kind of how that one that we just looked at just a few moments ago, the starting point was kind of lower left and it finished in the upper right area. But if you just think about, right there. So if you think about buying whenever it's in a dip after it's had a little bit of a pullback in performance, you're essentially just starting closer to what would be like a max drawdown area. And from there, you typically rise back up. So if your expectation is that it's going to look anything like it has in the past, and of course you can't guarantee that, but if that's your expectation that the program is going to continue in a similar fashion, then buying after down months, a couple down months in a row provides a much better return to risk potential on those programs, and that kind of works in any type of trading system as well. If you've got a trading system that has a long-term historical edge, buying after a series of losses is just kind of cutting down your initial risk that you have to get started with, because it's not going to take as long to get down to wherever that max drawdown is, because you've already seen part of that play out. So it's just kind of mitigating some of your risk when getting started.
Yeah, it's basically like discounting some of the drawdown as you enter the program. You're essentially discounting some of the drawdown, because even though nobody can guarantee where the drawdown will stop, it may continue. But coming at a new equity high, you're much closer to maximizing the drawdown than coming into an area where the program has been sideways or falling. And that's the principle behind this. But overall, the idea is not to try to trade the trading system, which I've seen so many times. People try to time a trading system and hop in and out. There are systems out there that you could choose to take a signal or not, and putting that much power in the consumer's hand. Not because we think a consumer is not smart enough, but the emotional component of this is very, very important. Max, you were about to say something.
Yeah, I was just going to say, on the opposite spectrum, if you're waiting for a positive month to invest, all you're really doing there is missing out on those profits from that month, right? So, you can look at it in two ways. If you wait until the system's in a drawdown to invest, you could potentially catch the upside and miss the drawdown period, which we know past performance is not always indicative of future results. But if you are waiting for that positive month, all you're doing is missing out on a positive month of P&L.
Yeah, if I can just add here too, as someone who's been in the systems game here for a really long time, we've done a lot of research on this, and quite frankly, if we could predict when the month was going to be positive and when it was going to be negative, we would just turn systems off, because we have a lot more information about this than anybody else does. So you're probably not going to outguess the system developer on what's going to be a positive month and what's not. And if we can't do that, you probably can't either. And with this type of stuff, whenever you have a positive expectancy in your trading system, the best time to get started is as soon as you can, and then you can think about adding in a drawdown, so that you can potentially get a better spot in the future. But if you got a positive expectancy, you just want to get in on it and let that expectancy start to play out over time.
Right. So that's one of the factors. That's also the reason why it is almost inevitable that people would get it wrong. If you're someone who, I've dealt with just literally thousands of traders as a person who ran a prop shop, and also just coming online and having all these followers and the brokerages and so on. It's just people come from fields where 2 + 2 = 4, and they try to bring that level of precision and education to trading. And one of the things you discover about trading as we beat our heads against the wall is that it's just a murky business. So it doesn't matter when you get in. You're always going to look back, a few weeks or months down the line and go, man, I should have timed that better. It's just never perfect. So don't bother. The other piece of best practices advice we have for you is to spread multiple allocations over time. So if you're going to take more than one unit is to kind of dollar cost average the investment, the allocation, so that you're not grabbing one point of time. Consider adding to your positions during drawdowns. This advice is very common in the investment community as well. You know, when the market's falling, this is a time where you might want to allocate more to risk versus selling or pulling back, which is what people tend to do. People tend to get scared that they're going to lose their savings and so forth, which is very possible. Nobody can guarantee performance, but it's just better to allocate money as the market's pulling back. Achieving compounding of returns by using account growth to fund additional allocations. So even though this is futures and we trade in terms of units, there's really no compounding of returns. In other words, if you put $100,000 down in ES and you make $10,000 in a month, let's say, you don't get to allocate 110,000 the next month because you're still only trading one unit. But eventually, hopefully, you have enough to create an additional allocation and now trade 2 units of that product. So this on a planned basis. This is what it takes to kind of build up in this sort of program. Again, the advice of adding to your positions during drawdowns is not doubling down or averaging in or any of that stuff. This is planned. This is a planned allocation based approach. You want to go over the mistakes, Matt?
Sure. So, you know, as with anything, you don't want to put too much of your capital into anything. As the crisis correlation showed, putting too much of your capital in any of those instruments had a horrible effect last year, especially on, well, some of them could have been really, really bad. And that's the same thing with trading systems and whatnot. You don't want to put all of your eggs in one basket. Some of the programs have very attractive returns that can sometimes make people want to put a lot of capital into it and not think too clearly about how much they should be putting into it. But this is just one piece of the puzzle. There's a lot of ways to make money in the markets, and this is just one of them. So be smart about allocating and not, you know, doing all in on anything, this included. And then micromanaging your returns essentially by trying to turn on and turn off the program, getting in for a month and then trying to turn it off because you think there's going to be news announcements or something that are coming out that are going to impact the market. And you want to sit out because you think you can time it. That's usually detrimental to the client. The best practice for these is to just get in, commit to it on at least a 1-year basis. Let the statistics play out, because it's these programs use statistical edges that are based on a giant database that adapts to the market daily. We're constantly taking in new information each day as the market does whatever the market does. We're recording all of that data into a database, and that causes the programs to continue to adapt. So they are continuing to adapt to the markets as they go. So you just want to let them adapt as the market grows and let it play out according to the statistics. Morad just talked about the compounding is not automatic in these. The way that they trade is you license the program, and whatever you license is exactly what it's going to trade. So it's not going to trade bigger as you make money or trade smaller as it goes into a drawdown. It's going to trade the same position size until you decide you want to add or remove part of the position from it. And then lastly, you know, taking the funds out before allowing it to really play out is usually a mistake. A lot of people that want to, you know, try it for a month and just see those types of approaches is probably not worth your time. You want to give it time so that the statistics can play out, and it's taking a shot. It's taking a shot on the markets about every other day. So it's not, if you go at it for a month, it doesn't mean you're going to get 20 trades taking place. You may have 10 days that are traded in a month. So you want to allow lots of samples to play out. The more samples you get of trades, the higher the probability of it falling in line with the historical probabilities. So just like you can flip a coin, a handful of times and come up with, 3 or 4 heads in a row. Well, if you do it, a million times, you're probably going to end up with, a 50-50 type of probability historically, whereas short term, you can kind of come up with whatever. So just commit to the long term, let it play out, try not to micromanage, try not to step in and think that you're smarter than the program. It'll sometimes do things that you don't see, and that's because it's seeing information that you're not seeing. So just let it do its thing. And our clients that look back, a year down the road, they're generally very happy with where they've ended up.
I mean, the piece about withdrawing from the program before the end of the first year, the piece about account pauses, I got to tell you from my own experience that just people are really horrible at timing this stuff. We generally see folks stop something really close to where the bottom is, or generally see them insist on going in really close to where the top is about to form. It's just uncanny. And so our view is, and this is why this is a subscription, this is an annual subscription as opposed to something that we'd want you to kind of manage on a day-to-day basis. You don't need to do anything but follow the steps that Max has outlined in the previous slide about, going to EdgeQX.com, opening an account. And once it starts, just put in enough that you're okay with not watching it on a day-to-day basis. However, because this is futures and it's extremely highly regulated, every time the program takes a trade, you will get an email that evening from an independent party, the clearing firm, telling you what trades have been taken, what your account equity is, how it's performing, all that stuff. And you get to see, and that's the transparency part. In other words, it's not like investing in a mutual fund where you might get a quarterly statement and you get to find out 3 months down the line what it's done. This is every night you get to see what positions were taken, the exact prices it entered and exited, and what that meant in terms of costs, profits and losses and things like that. It's very, very transparent. And even though that's coming in every night, we recommend just letting the program do its thing and assessing it, maybe 6 months down the line, or when the annual subscription is about to renew, you look at it and say, how does this fit my risk profile? How's it done? And then make a determination. Before that, doing it before that, or deciding on a day-to-day basis that I'm going to, I think the market's probably going to get rocked here and I really need to just pause. That may be the best time for this program to outperform the market. We just don't know. So the idea is to keep taking as many trades as possible, as Matt said, and just let it kind of do its thing. This is trading in its rawest form. When we look at trading in general, one of the items that is missed that I talk about a lot to the public is it's all just statistics. It's the outcome of every trade is 50-50. We cannot determine it. It's somewhat random. But when you take all of those individual trades and put them together, you get some sort of a trend, and we call that a historical probability. And so the idea is to just keep it in there and keep it going, and make assessments on predefined dates. You can call your personally assigned broker, your personal broker at EdgeClear, to say, hey, what's going on here? Is there anything anomalous? If there is a concern, otherwise let it be, and that's what we prefer. And I'm not saying that because we're running the program. I'm saying that because the more successful you are trading this, the better we do as a whole. If you're not successful with this, then we're not going to be successful. Okay.
Well, small correction. Just want to reiterate: they are emailed, or these statements go to a portal that you can access on a daily basis. Just want to mention that.
That's correct.
But we did have one question in here. It looks like, is this one algo or a bunch? It is one program with a group of strategies within.
Yeah, so real quick on that. So the EdgeQX program is a collection. There's probably around 10 or so different strategies that actually make it up. And it's got a combination of some mean reverting type of strategies and some momentum type of strategies. They can go long, they can go short. There's strategies that are looking for like small targets, just kind of like a hit and run type of trade that's maybe in the market for just, an hour or something. And then there's other strategies that are within the program that are trying to capture big moves. And to do that, they're generally trying to get in on days where they can get in and have a reasonable probability of trading without hitting their stop and being able to hold for the entire session. And that's how you can capture some of the bigger trend-like days is getting in and holding until the end of the day. A lot of times, the high or the low of the day is actually made in that final 30 minutes of trading. So that's kind of the idea behind some of those strategies is get in and hold until that final 30 minutes or so and be able to do it without having your stop hit in the process. So you don't get those days every day, but we've got several strategies that are trying to take advantage of those types of edges as well. And when you put them all together, which is what the EdgeQX program does, it gives you a nice diversified mix. That way you're not too reliant on any single strategy or just reliant on the longs or shorts. It's just a diversified program that's being made up there.
Excellent. So, Max.
We got a little special for everyone here. Join EdgeQX by March 31st and you'll receive $100 credit towards your annual license fee. Sign up at edgeqx.com. This is for the MES program. So if you want to take advantage of this, I think there's a giveaway as well after this, but feel free to go to that website and just submit a contact form and we'll get you up and running. Anyone have any questions? Positions could go over a number of days. No, these are all intraday positions, intraday trades.
Yeah, so normally the strategies are entering somewhere around the open of the regular trading hour session, which is about 9:30 a.m. Eastern time. And it just depends which strategy is trading for the day on how long the trade's going to take. So again, some may be out within the first hour, some may hold until the end of the day, but everything is closed out by the end of the session. So nothing is held overnight. You're avoiding overnight risk, weekend risk. You don't have to wake up and wonder if your account's down sizably because there's a giant down gap taking place. You'll be able to rest easy knowing that you are in cash overnight every single night. And the other important thing to know is Max and his team here is doing all the execution. So when you get started, you basically open and fund the account, and then Max takes care of everything else for you. So he's actually running the software. The software is all 100% automated, and it's doing everything for you. And Max is overseeing it and all of that stuff to make sure that everything's doing exactly what you expect it to do.
Yes, it's fully automated with human oversight. So we're able to monitor it and watch it to make sure everything is going okay.
Yeah, so nobody's trading your account. We don't trade your account. It's the system takes the trades, but we have a team that oversees it and makes sure it's operating within parameters and can intervene in case something's not right. But nobody's actually trading your account. The account's simply getting signals from a black box and putting them in the markets.
And then we allocate at the end of the day to your account. So there's a few questions. Annual fee, it is $590 normally for the MES, $100 off till the end of this month, $590. And then the ES program is $4,900 for the year. And keep in mind the statistics on our website, the cut sheet, that includes the annual fees.
Yeah, if you go, so I wanted to address that because, sorry, Max, you were saying.
No, go for it. Go for it.
I wanted to address that a little bit. Historically, my experience with these systems has been you choose a system. There are various vendors for this. You choose a system, a subscription, a monthly subscription, is paid to the system vendor, the creator, and then the trades are executed on a monthly basis. Generally on a system, you're looking at $200 a month, $300 a month, and so on small programs, meaning $25,000 or so. And what we want to discourage folks from doing is to then decide at the end of the month, well, it's kind of like a gym membership, I haven't gone, so I'm going to cancel, or no, I want to start it. Maybe I'll cancel for 2 weeks because I think the FOMC is going to do something, and then I'm going to start again and pay that subscription fee. We want to avoid that whole thing. And for the $100,000 package of $4,900, the relative monthly fee is low for that size program, but we really want to tie you in to the subscription for a year, not because we want to lock you in, but we want to reduce any incentive of trying to trade the program, which is what I've seen happen with monthly subscriptions. For the MES at $490 with the discount, it is cheap for $10,000. But the most important thing is what Max said, which is if you go to edgeqx.com and scroll down about halfway down the page, you'll see the cut sheets. The performance is highly regulated. This is a performance that is reviewed by the NFA before it was first published, and it has to include all costs. So what is shown there has to represent a client's actual account. And so you don't need to worry about the performance before fees. The fees are included in the performance. So we include the value of the annual membership and any execution fees, exchange fees, NFA fees, all that stuff is already embedded in the performance, and you should know that.
There's a few other suggested minimums are $10,000 for the MES and $100,000 for the ES. If you would prefer to fund with $15,000 for the MES program, what you're doing there is decreasing the exposure, the leverage exposure that you have in your account. So if you would prefer that, then yes, you could do that.
Yes. How much is the minimum funding amount is the next question.
I just mentioned that. It was suggested was $10,000 and $100,000.
And someone's asking here, Matt, since you're InvestiQuant, can you provide an example of a trade the system might take or an example of a statistic it might use? Is this getting into your secret sauce, or is there something you can say about
I can certainly give a trade example. I know we had one at the beginning of the month, which is I'm only remembering it because it was a memorable trade. It was March 2nd. I can't pull charts up in here, but on March 2nd, and essentially we went long the S&P around 9:30, and we got out around 4 o'clock, and these are Eastern times. So that was March 2nd, and that would have been an example of one of those trend day type of strategies that triggered. Not all of our strategies do that. That was just one that I remember here recently because it was pretty sizable. It was like I want to say it was something like 60-point type of up move. And that's not happening on every single trade. We certainly lose trades as well. But that's one that you can pull up a chart on if you're a chartist and take a look at what that looked like entering around 9:30 a.m. Eastern time and exiting at 4 o'clock. It was a sizable down gap that day that turned into kind of a trend up day.
Max,
Yeah.
you got the questions?
Yeah. Mobile app. So the program itself, it cannot be viewed in real time. And there's a few reasons for it. One, just the way the LOD and the platform is set up and the accounts are set up, can't actually be viewed in real time. That's where the daily statements come into play. So because of that, there's no mobile app to view the positions on the account.
Just so let's expand on that a little bit more because we do have a little bit of time. This isn't a computer that's trading your account directly. This is a system that sends a signal, and we tell the system how many contracts it should trade based on the number of people taking the signal. Then we take the signal in one account, our account, and then at the end of the day, your clearing firm then takes that and spreads it across all of the accounts that should be taking that signal on an average price basis. So it's not a leader follower type of program where the trade is done and it's just copied onto your account. That's not how this is done. And traditionally, that's not how professional programs work. Generally, professional programs trade it in the block. We set risk allocations for the block, take the trade in the block, and then allocate those trades, push those trades at the end of the day to your account, the buys and sells on an average basis. That way, there isn't a chance that, Jane got it, Joe didn't, because Joe was doing something or has done something with their account. It's done cleanly. And that's why we say, at the end of the day, you might want to check your daily statement to see what trades were made. You cannot watch these in real time. Okay.
A couple of it looks like another question was, can you pull on a trade example, then mention it verbally? I don't know, Matt, if we could pull up a specific trade example on our side, but I think what Matt was saying is the chart. What day was that, Matt? It was February.
March 2nd.
March 2nd. You can kind of see that the program entered at 9:30 a.m. Eastern time and exited at, correct me if I'm wrong, it's 4 Eastern. 4 Eastern. Yeah.
Yeah.
Let's see if we can find that. Right here. This is March 2nd. This is the open of March 2nd. So the trade went off on this bar right here. This is a 30-minute chart. Okay. This is, by the way, this is a back adjusted June ES. The trade was done in a March ES. So prices will be slightly different, but the overall gist of it will be the same. You can see this type of day where the market opened right down here, the equivalent of 39.44. Again, that's adjusted for June by about 34 points. Tested down a little bit and then pushed right back up and through. And it was a momentum day, and that's the example you were talking about. So it would have opened the trade right there on the beginning of the first bar and closed it right. And I'm in Chicago, so the time shown here is Central Time, and it closed the trade right here on this bar at the close of this bar. So it managed to catch this entire move here.
Yep, that was it. And again, that's, we don't have those trades every day. That was just one I remember here recently because it was a big move in the market, and we happened to nail it.
Yeah.
Go ahead.
And the final question I have seen here is, would it show in the trade? Would it show the trades in a log? Just to reiterate more, it said the trades are actually being executed through an account of EdgeQX. That's why it's an LOD style program. And then at the end of the day, they're allocated each statement. So the log that you're referencing would be your daily statements and your nightly statements that you get when the trades are executed. So that would be that log.
A couple things. This is kind of a very trader question here by Cesar. Traders want to see the specifics. They want to see exactly when it executed, what it bought, what price, and so on. Your statement will show all the buys, all the sells. It won't show you, and they're usually sequenced in order of price. It won't show exactly which trade went off, how it was all offset, and so on and so forth. So the statement will show you what trades took place and what prices, and based on that, your profit and loss and everything else is computed. But overall, this is this is transparent, but we don't want the signal to be live and out there and under consideration. This is an investment. It's not a trade signal that you should be trading with in your personal account or against in your personal account. We want to discourage that. We want you to trade the edge that the program has, not the signals it generates. We're not selling signals.
Yeah. And then, there's another question about the expectancy on the MES program. Right now, the amount of data that we have from September to Feb, we would ideally like a lot more. But I think that falls into the conversation we had with the coin flip, the flip a quarter and it kind of evens it out. We don't have enough data right now to fully assess what you're asking. And that's why we suggest being in it for a year. We believe in the program though. And that's why we're here talking to you about it.
A couple things to keep in mind. If the expectancy is $2, negative $2 in the MES, but I don't know about you, but I was here every day, every trading day, January, especially February. It's definitely been rough. The market's flipping around. So it has not performed great in February, but that's okay. That makes it so that we go back to the slide before where we say you have a better opportunity during a drawdown. Potentially, in our opinion, you have a better opportunity getting into the program during a drawdown. We, by law, are not allowed to show the results that existed once we go live. So before we went live, when we went live in September, we used hypothetical results, some back-tested results. And once we start on the live program, we can't show those. We believe in the performance of this program. In fact, in my travels and dozens of systems, this is the only one that I came across that made sense to me because the people who built it, InvestiQuant, Matt, know what they're doing. And I think the overall performance will show itself. The example of the coin toss is very true. If I was to say, I will bet you the next toss, the next 5 tosses will have a heads as an edge. In other words, it'll show more heads than tails. Your thought shouldn't be, well, if it's a fair coin, there's a 50-50 chance. Well, there's no way to have a 50-50 chance on 5 tosses, unless you can make the coin stand on its end magically. Somebody's going to win in that case. But if I told you, I expect that it'll be heads after 50,000 tosses, there's a potential opportunity that at the end of it, the odds are 50.1 versus 49.9, meaning that the true edge of a fair coin is 50%. And the more trades you take, the more months that go by, the more the data converges on that 50% edge, the true edge. Whereas with 5 tosses, the data is going to be 66 versus 33%, and it's going to be quite wobbly. And that's the phase we're in right now, because every month shows some number that's kind of cycling. But over time, as with all trading systems, programs, including your own investments, your performance of your own investments and trades, that waving around of your expectancy tends to now start to line up with the overall edge. So if you've ever looked at an expectancy chart, or if you've ever looked at a win percent chart, at the beginning of a win percent chart, that line is just going nuts. And then over time, it starts to go flat. And that's where we start to say, okay, your win percent is 52%. And we can be very confident that it is 52% versus the first 3 trades where it's just whipping around, where it can go 100% to 50% to 33% back to 74%, and it just starts jump around. And that's where we are. This is a very new product. It's only been trading since September. So as you're scrutinizing the numbers, understand that cost is included, that the numbers are in a phase, in a natural phase. This is the difficult part, in a natural phase where there's a lot of volatility in the results themselves, but not in the signals. Over time, the signals are consistently the same because they're quantitative and statistics based, and so we expect it to level out over time. But by then, we will have maximized. We can only have so many people taking the signal before we start to impact the program adversely. By that time, the number of units will have been sold through to subscribers, and then we will not be taking subscribers at that point. That's a key element. So reaching out to you a little bit earlier for this opportunity, including the discount, to try to get the program to where we think it should be. Okay.
All right. Well, I think we're out of time.
Yeah, no more questions. We were so succinct and clear.
Well, that was an outstanding presentation. A lot of food for thought here, especially among the professional traders. I have also done a lot of work in these high-level quant areas. So it is a fertile field, is all I can say.
Excellent. Thank you for having us.
Thanks, John. Yeah, thanks for having us.
Well, love having you on. Always room for pros here.